Now that we have finished discussing the concepts of fire insurance, let's now proceed to its accounting treatment. Insurance contracts are covered by IFRS 4, which is equivalent to PFRS 4 in the Philippines. This standard applies to insurance contracts and reinsurance contracts. Let us first be familiar with some basic terms. First, claims expenses. A claim occurs when a policy falls due for payment. It refers to the amount payable by insurer to the insured when policy becomes due or the mishappening occurs. Therefore, a claim arises when the loss occurs or the liability arises. Claims expense is computed by adding claims intimated, survey fees, and medical expenses, then subtracting the claims received on insurance. Next is the commission expense. The Insurance Regulatory and Development Authority Act regulates the commission payable on policies to agents. Commission expense to be charged to revenue account is computed as follows: the commission paid, add the commission payable at the end of the year, and less the commission payable at the beginning of the year. Third is the premium income. The payment made by the insured as consideration for the grant of insurance is known as premium. The amount of premium income to be credited to revenue account for a year may be computed as premium received on risks undertaken during the year, add the receivable at the end of the year, less receivable at the beginning of the year, and less the premium on reinsurance ceded. Next is reinsurance. If an insurer is not willing to bear the whole of the risk, it reinsures itself. Some risk retains with some other insurer. Another is the commission on reinsurance accepted. The reinsurer generally allows commission to reinsured on part of business ceded. This is treated as expense of the company. And lastly, commission on reinsurance ceded. Reinsurance generally gets commission for giving the business under reinsurance contract. It appears as an income in revenue account. Let us now take a look at its journal entries. On the books of the insurer, in accounting for regular premiums. To recognize a renewal premium on a regular premium policy in which the premium falls due, we debit policyholder or intermediary debtor and credit premiums written. When the premium is actually received, the following entries will be made: debit cash and credit policyholder or intermediary debtor. When accounting for single and initial premiums, cash is usually required when the policy proposal is made, and the accounting entry would be debit cash and credit premiums written. Accounting for claims. Notification by the policyholder will be received by the insurance company. Then, the insurer will immediately set up a provision for this amount, debiting claims paid, a technical account, and crediting claims outstanding, a balance sheet account. The company will then investigate and necessitate requirements prior to paying the beneficiaries. Once the investigation is completed and the requirements are received, the following entries will be made: debit claims outstanding and credit cash. Accounting for commissions. A policy is sold by an agent. The agent receives commission at a certain rate of the annual premium value. The policyholder pays the first month's premium, and thus the accounting treatment for the commission is debit deferred acquisition costs, a balance sheet account, and credit due to intermediaries, a balance sheet account. The asset for the commission would be written off to the technical account over an appropriate period. Traditionally, in the UK, the write-off would be over 12 months. So the monthly entry required would be debit acquisition costs, a technical account, and credit deferred acquisition costs. When the agents are paid, the entry is as follows: debit due to intermediaries and credit cash. Let's move on to the journal entries on the books of the policyholder. In the acquisition of insurance, a debit to prepaid insurance and a credit to cash or accounts payable is made. Next, we have the claim of insurance. We debit insurance claims and credit asset loss due to fire. And lastly is the settlement of the insurance. We debit cash or accounts payable and credit insurance claims. Let's have a glimpse of sample financial statements concerning insurances. We have the statement of financial position, the income statement, and the statement of cash flows.